If you break it out, prices for car repairs, pet food, frozen food, vegetables, they are growing the fastest. Airfares, gasoline, health insurance prices falling the most. I question the thing on the airfares, though. Here with more on how all of this impacts the Fed is Joyce Chang, chair of global research at JPMorgan. So in what camp do you fall? Or do you believe that the Fed will pause tomorrow but signal its readiness and willingness to continue raising rates as needed?
Well, I'm in the pause camp, but a pause is just a pause. And I think they will signal that their bias is to hike. And even though you've seen inflation come down a tick, you see that something comes down in inflation, energy, but then food prices go up. And so just U.S. core inflation, it's been resilient, it's been sticky. And I think that Jefferson signaled this very well. They're going to pause, really assess where they're at. But I think the bias is for hiking, particularly when you look around the rest of the world, because that's what we've seen other central banks really doing as well, as inflation has remained resilient.
So what is the terminal rate then? Is it a quarter point above where we are now? Is it a half point above where we are now? Can you say?
I think it could still go another 25 to 50 basis points from here. And you could really well see that we're still talking about the recession risk, but everybody's talking about, is this a first half 2024 recession? Because the macro data that's coming out is just also very resilient. So the global expansion has been resilient, but inflation has also been resilient. So I think that is still an ongoing risk. I know soft landing is what a lot of people are talking about, but I would be more in the no landing camp, and that you have this risk, just wait for it. It could play out later in the year, early next year.
The markets are something to ponder, when they look at some of the all-time highs we're notching today, when they look at the strength of, tech stocks in particular, but just any kind of momentum area. We mentioned Tesla and Netflix just a moment ago. How do you think that factors into the Fed's decision?
I think that the Fed has actually looked at the market movements and really separated this. I mean, they've separated also some of the financial stability concerns from really looking at inflation. And I think a lot of the central banks had sort of multiple things they were looking at, and they've really come back to their core mandate on inflation. So it wouldn't surprise me if some of this momentum continues a bit, but I would also not be surprised if in the summer, as liquidity gets weaker, and particularly when you look at what's happening in the Treasury market, bond markets, that you have more of a sell-off in risk assets. And that is more of a July-August phenomena that could play out.
Treasury yields up a little bit today. What are bonds implying about equity pricing over the next months?
We've taken a look at this, and, if you look at equity vol, it's pricing in like a 3% chance of recession. We've really looked at this and said, if you had the same inflation dynamics being priced in that bond markets are pricing in, you'd see equities 20% lower. So you're seeing some real dissonance between bond and equity markets and the Fed. Well, I think that the bond market has it right, but the timing has been really tough on this one because we've had so much government support. We still had 5% government spending in the first quarter of the year that, everybody's been waiting for the recession. Since Russia's invasion of Ukraine, every quarter we said the recession is starting. So I think there are many people thinking, well, I can't in the equity market afford to miss this rally. And you're getting pulled back in. Now, for a fixed income investor, it's different because you can stay in cash and, and in the short end and still get a very decent yield. But I think in equities, there's a sense of, well, if you think this recession is not coming until next year, am I going to be missing out on this as you look at the data that's printing?